And we are live on Oz Property Investors. We bring the big names and we bring the big late fun. How you going, Mike? And how you going, Steve? What's happening?
Very well.
Yeah, I'm good, man. Really good. As you've kind of mentioned on the socials, I'm off to Budapest in a few hours.
In a few hours? I thought you were already there. Like, what?
No, I'm going there. I said I've got to go to the airport. You might have assumed I was coming from the airport.
Ah, okay. Yeah, there you go. You've already just. So wait, do we have to get this done by a certain time? Like, you miss your flight?
My flight's in like 5 hours, I think. So as long as I'm out of here in 2 or 3 hours, it'll be all sweet.
Okay, we'll make it 3.5 hour session. I'm sure you're fine. So how are you going in, Mike?
I was going to say, you know what the embarrassing part is, Jeff? I was actually going to see Justin Bieber in concert, but he cancelled. We cancelled 3 days ago. He's cancelled his tour.
What? Yeah. Bieber? What's going on?
Biebs is a little bit sick, unfortunately.
Another issue on the Gold Coast. So you get a few tattoos and go a bit wild. But no. Interestingly, I heard that Ed Sheeran did. I mean, I heard this from my dad, so don't quote this. But I heard that Ed Sheeran 130,000 the MCG the other day. Did that actually happen? Like, was it 130? I was like, how does that even work?
Whatever they fit in there, I suppose, because you've got the stadium plus you've got the floor, which you don't normally have at a football game.
Grassy bit, yeah. They could cram it in. They get 100,000 there, plus a bit of grass work. Yeah. I'm sure they put a cover on it or whatever. Yeah, they could do that. He's popular.
Well done. Yeah. Good old Eddie. Good old. Yeah. So anyway, today, commercial property and how to make money in any market. I suppose I change between any or current market. So I think current market makes a bit more sense. But what we're going to talk about with Steve, and we've brought along Mike because Joe's still gallivanting around. I think he's on a plane at the moment. But we're going to talk about the current market conditions, strategies on how to do well in the current market. And there's going to be spreadsheets, commercial property depreciation with Mike. You have to hang in until hotspots, which people sort of rib me about a little bit, and commercial data. So it's going to be a fun-packed and fun-filled session. And ask questions, throw comments, give us, if you're on YouTube after, let us know, share some love. We're getting a lot of fun on YouTube as well. So not too many spam bots.
Just saw the first comment is, I'm a believer.
Yeah. I felt it. Once fell asleep on a train going to Sydney Olympic Park, and it was a Justin Bieber concert. I woke up and I just thought, what have I gotten myself into here?
With 20, 12-year-old girls around you? Where
No. So thankfully I was with the partner. So it was nothing. Yeah, nothing was weird. We just had been to Newtown.
Somehow it still sounds weird, Jeff. I don't know.
Okay. All right. So quotes of the week. Palise, you want to go first?
All right. Mine's from, let's just say, an anonymous source. A common first goal is to have a hunt. No, I'm joking. Mine's my favorite quote, and it's Winston Churchill, and it's history is going to be kind to me because I intend to write it.
Oh.
So basically, this just means take control of your future. Don't leave it in the hands of anyone else. Just have a run and have a crack at life.
Isn't it ironic though that Winston Churchill, he's quite a polarizing figure, I believe. Like some people really think he was a great statesperson, and others are like, oh, gee, this Churchill guy was a little. Yeah. Am I incorrect there, Mike? Or you strike me as a bit of history buff.
Just because I'm a nerd.
I am too.
I think if you were English, in the 30s, you were probably pretty pro-Churchill. But yes, I mean, like he was a pretty famous alcoholic. He sort of brushed his teeth with champagne, and he was a very sort of divisive and decisive alpha male of a character. I mean, that's a very alpha male quote from an alpha male man with that giant beard, which I think is an affront to International Women's Day, which we should tip our caps to.
Yeah, I realise that. I shout out to International Women's Day is really. I was almost going to do a post, but I didn't sort of. Yeah, it's an issue. Like I don't want to be just somebody jumping on the bandwagon, but it is one of those really. I thought we should have got a female host. I'm sorry, Mike. You are fantastic, but yeah. But no. So that's interesting. Yeah. So what is your quote, Mike? Or do you want me to? I can go first or next if you.
No, I got one. This one I'm dedicating to Palise because like he's a man of the world, traveling around and it's inspirational as probably half as much as it is enviable. And this is a Mark Twain one where he said, "Broad, wholesome, charitable views of men and things cannot be acquired by vegetating in one little corner of the earth all one's lifetime." So here's to broad charitable views from the Steve Palise.
Ah,
Well
I like
done.
that, Mike. I like it. Yeah, I really like that.
I have
And
to think about these quotes too much.
I actually have that conversation so much with clients, like especially we were speaking before this chat, like the high net worth clients and stuff like that. And they're still just in their little cubicle in the city working on, and like there's nothing wrong with that. If you enjoy making money or doing what you're doing, that's fine. But there is a bloody big world out there. Like there is some fun you can have.
Aconcagua 2025, going to make it happen probably.
Oh, yeah.
So mine is take time to deliberate, but when the time for action has arrived, stop thinking and go in. That was by my favorite French general, Napoleon Bonaparte.
So say that again.
So it's basically about stop thinking and start doing. But take time to deliberate, but when the time for action has arrived, stop thinking and go in.
Yeah, cool.
And Bonaparte certainly did not mince his words there. He certainly did go and he had a crack a couple of times, but I think he had the kind of small man syndrome going on there. I think he had a few a few character flaws, but he did manage to conquer a few things. Lost quite significant.
It's tough growing up in Corsica, I'm sure.
I should have studied a bit
really
harder.
significantly in Waterloo, 1812. I think that was the battle where he got his behind handed to him, didn't he? Was that did the French win that? Gee, I should know this.
I didn't study for this history exam we're having in the first 10 minutes of this call.
Okay. If you read the pre-notes, you would have seen those. Yeah. So anyway, guys, we got to go and get into some commercial golden wisdom because I'm interested to drill Palise with some hard questions. But first, we need to introduce our first ad of the show. So we're going to tune in to Mr. Scott Agate. So here we go. It's going to be seen. I'm glad Joe's back next week because I don't necessarily like doing this thing, but we're going to make it happen. Here we go. Okay, that's not the screen I wanted to share.
I can see your head.
Okay.
Looking good though, Jeff.
Yeah, it's a good size head.
Oh, wait, hang on.
It's all in proportions. I like the angles.
Good shadows, good contours, lovely vectors.
Okay, I need to actually share this one here.
Wisp of beard, but not overdoing it.
Yeah, it's still well groomed. Shirt might need a little iron, but I can't tell if it's just the lines and the striations.
Strong Adam's apple. He deserves points.
Jeff actually does have a really strong Adam's apple.
Here we go. I pressed the wrong button, but that's okay. Here we go. Smooth. Completely smooth.
There's nothing worse than going into a situation unprepared, especially when that situation is purchasing one of the most expensive assets of your life against a trained property expert in the form of a real estate agent. It's a scary thought, but it is a skill that can be taught. Do you want to learn how to become fully prepared when buying a property so you can get out there, buy your dream home or investment property without the fear of actually messing it up? Scott Agate, the founder and expert property negotiator at Hello House, has been helping people buy their properties by stepping in and negotiating with the agents and saving his clients tens of thousands and in some cases hundreds of thousands of dollars. Scott has now decided to share all that he's learned over the past 28 years in real estate so you can go out there and do the exact same thing on how to find a property, analyze that property, negotiate on that property, and transact on it to get the best results. He's created the Get Buyer Ready course, which is a step-by-step guide on how you too can become an expert property negotiator. It's the easy way of how you can avoid all of these agent games and get the best purchase price on that dream home or your investment property. The course is in short bites for busy people with no fluff at all. Just all the information you need to get buyer ready and secure that next property with confidence at the best price. Scott has been kind enough to give our community a massive discount with the link below. Sign up today before you even think about putting an offer on that next property, and it will be one of the best decisions you can ever make.
There we go. Ironically, spoke about getting ready. So something that Jeff did not do as much as I could have. Let's see. So stop sharing. I'm back. We are here.
While you're doing that, Jeff, just so that you don't ask for the exorbitant fee for my co-hosting gig back, I want to start with a question with the Steve Palise, MMA's only 1-0 fighter from the property sector. What is what is the current property market? Because, we've had an interest rate rise, so everything's different compared to last week. Because we're talking about, how to buy in this market, Jeff. But what is this market? Let's define it if we can, maybe.
Should we introduce Palise first? You're on mute, by the way, man. But while he's on mute, let me take. Oh, that was a great question, Mike. So actually, no, you're not. People know who Palise is, but yeah, you go. So tell us about define the current market. Steve.
All right. So, Mike, as you know, I like making my decisions based on weekly information, not like 10 years. So just current market, that's sarcasm, everyone, by the way, just in case you run off and think I'm serious. Current market's still strong in terms of the fundamentals. So for commercial vacancies, we're going to go into this a bit later, and I've actually got the reports to show you. Vacancy rates are an all-time low. Rental increases at an all-time high. Unemployment's at an all-time low. So all that concoction shows that people have money, they're willing to pay more rent, and the vacancies are getting tighter, so the properties are getting more demand. So the argument, and most investors and kind of commentators are saying, like, interest rates are going up, therefore prices have to go down. But that's not necessarily true, because commercial and resi has both been growing the last 3-4 years, and interest rates have been going up over 5 years. So there's more to it than that. There is the supply demand type side of it. What's sort of happening, and the bottom line cash flow, and we'll go into some spreadsheets later and I'll show this, isn't really changing that much with commercial, because the rental increases are cancelling it out. So where you might have lost $5,000 in cash flow from a higher interest rate, you're bumping up the rent $5,000 because the vacancy rates and the rental increases are so high. Just to give you some numbers, industrial rents last quarter, so I'm talking the last quarter of last year, went up 8% on average across the capital cities of Australia. 8% in one quarter. And then this is why it's kind of a bit of a delayed effect with commercial, because with resi, as soon as your 6-12 months is up, you push up the rent to whatever fair market rate is. Commercial, you're on 2, 3, 5, 7-year leases. It comes a bit later, especially if they're on fixed 3% or smaller CPI and things like that. So all the kind of in-demand properties, by the way, there are some bad commercials you can buy. The in-demand properties, generally, if the lease is coming up this year, next year, you're bumping up the rent on like an industrial by 20, 30% sometimes, and that's helping with the interest rate growth.
So how do you determine, I want to pick out a piece there, how do you determine a good versus a bad commercial?
All right, this is the $1 million question, because there's so many moving parts with commercial. Like you've got like who the tenant is, the location, foot traffic, road traffic, supply, demand, vacancy rates, occupancy rates, fit out costs.
What's the key factor? What do you reckon?
Key factor for me is low vacancy rates. I don't want to buy a client or myself a property that's going to sit there vacant for long periods of time. It's a good indicator that the property's in demand. So if you look in an area and the properties are getting, I don't know, say like Brisbane, and like vacancy rates about 0.6% at the moment, and I'll show you some around the ground stuff later, that's generally like 1 to 3 months vacancy. So if you're on average getting your tenant, say 7 to 12 years, having a couple months vacancy is not that different to having a resi. You lose a tenant for a week every couple years. So that's the main one. Then watching out that the future supply is not going to outstrip it. So don't buy like on the edge of a city where they're going to build 200 warehouses, for instance, and then you're going to have an oversupply in the market. So buy like something surrounded by residential, that population's growing. They're not going to have less of a demand for car mechanics, wholesalers, distributors, fabricators, storage in 10 years' time when there's more people there. So if the same amount of stock's there, lease demand will be there. I'll never promise capital growth, but I'll kind of promise demand. I'll say, look, here's the data to show that this property will be in more demand, and then the market will do its thing. Like there's always something. There's always Royal Commission, APRA lending restrictions, pandemic, removal of negative gearing, war in Ukraine, supply chain issues, etc., etc. But the actual stats behind it are still really strong. So if you're making a decision based on a 10-year decision, not a 2-week, 1-week decision, the fundamentals are there. And to be honest, you should be planning for high interest rates. Like even when I was sending clients properties 5 years ago, my cash flow spreadsheet table went from 2% up to 10% anyway, just so we could see what happens over that time. 30 average is around 6-7%. So you should actually be doing your calculations off those anyway.
I've heard you talk, Steve, as well about kind of the flexibility of the tenant as well, right? So something that could suit like you said, like a car mechanic, or it could be like a little shipping business that's shipping out their widgets and that sort of stuff. That's a real weird nuance of commercial, right? Because it's like, well, I bought a residential investment property, but only men under 35 can rent it. Like commercial does have that sort of weird aspect to it, right?
Yeah, and weirdly enough, the versatility also changes depending on where you buy. So like if you're buying in like a big, heavy industrial complex, those types of tenants are like the dirty ones. And what I mean by that is like the fabricators and the big like grease suppliers and things like that. Whereas if you buy in like the residential areas, they're normally the service-based businesses. So the car mechanics and the spray painters and the little suppliers to the local, the kitchen fabricators and stuff like that who service the local community. If you buy some that are near a port or an airport, they're normally distribution-based businesses there as well. Then if you buy one on the fringes of the CBD or in a good kind of like a hub, like where businesses operate and they need staff, they're the more combination office space warehouses that might be like 50% office, 50% warehouse floor space for their product. So there's nuances within nuances, the same as there's markets within markets for residential. You're just adding a whole nother layer with commercial because you've got the type of asset, which is like industrial, for instance. And then you've got the percentage of office to floor space. Then you've got the types of business that are actually allowed to operate there. Like a bed is a bed in a residential, but you've got different zonings for the types of like ones they can operate there. Then what are they actually servicing? Are they the kind of the blue collar, the white collar? Are they servicing the local community? So you've got all those aspects to it on top of just saying it's industrial. And then that completely is different for office space, even more different for retail. Retail is really complicated because it's about kind of analyzing businesses, foot traffic, road traffic, a few more risks there if you don't know what you're doing.
And I'll say, if you want to look back, we do have a previous show with Steve about how to analyze and do diligence. So we won't go too deep on that one, but look back in the YouTube archives and you will find Palise with probably a
self-promotion, Jeff. Go on my website, use Ozprop. I'll send you that for free. Literally for free. It's 100%. So just go and get it for free.
So Ozprop is 100% now, is it? Or
100%. I haven't changed it since my birthday last September.
Oh, okay. Jeez.
I've been seeing those birthday ads for months too. Like, it's like it's your birthday every day, and I thought that can't be true. But then I see your Facebook posts like, here I am on a camel in the desert. I'm like, maybe it is his birthday every day.
He's a lucky
that post literally just people keep commenting and it just keeps going on forever. I'm like, oh, let's keep this going.
So I want to know what markets give us a gift to the audience. What markets have you been most active in recently, and which commercial sector have you been in as well?
All right, so I've mentioned this on previous podcasts and Ozprop is I'm not a huge fan of office space. For me, it's like a high density apartment. You're paying a lot of money for a bit of concrete in the sky, and you don't have that scarcity factor because they can just build another 20-story skyscraper next to you and price you out. Vacancy rates, and again, we'll go into this a bit later when I show you some reports. They're kind of like 7 to 17% on average, so really high vacancy, which we all kind of, it's common sense. Like COVID hit, people aren't going to the office as much. They've got a few big stockers come to the market in like Brisbane and Sydney, and that's kind of pushed the vacancies up. So I've always bought suburban retail. So that's just like the neighborhood, medical center, dentist, hairdresser, barbershop, cafes, the stuff where the local communities kind of like. And we can talk about how to analyze those, but I really like those as a good long-term tenant. Slightly longer vacancy rates in some instances, but longer-term tenures from the tenancies. Yep. But industrial for me is a good one for first-time investors because you'll get comfort in the numbers because you can look at comparable square meter rates for rent, comparable square meters for buying, what ones went vacant, how long they were vacant for, and you can get some good like-for-like comparisons. So industrial there.
And where do you seeing value at the moment in that particular market?
Every capital city has really, really tight vacancy rates, like under 0.5%. So everywhere's good buy for long-term. I'm buying mainly in Brisbane and Perth at the moment. Main reason is the best bang for buck. So it's good affordable market. You can get in with 300, 400 grand. And what you get for 1 to 2 million is way better. Not better, that's the wrong word. Is way more value than say Sydney. Sydney, that'll get you like a warehouse in like a Western Sydney or a Penrith or something like that. There you can buy 5 kilometers from the CBD and get something twice as large with a bit more versatility. And you get a better yield. So yields that I'm seeing at the moment. So Brisbane and Perth, you're looking for industrial between the 6 and 6.5% is kind of the norm at the moment, which is quite strong. Sydney, you're talking kind of 4.5 to 5.2, same as Melbourne. And then Adelaide and Canberra are a bit of a weird one. It depends what you buy, but they're generally 4% to kind of 5.5. But there's stamp duty concession, so you're saving a bit on the way in as well. But again, they're little weird markets within markets. But if you're looking for good value and you've got kind of a sub $2 million budget, there's some really good yields and bang for buck in those areas.
Correct me if I'm wrong, Steve, but those sorts of yields were available, I think, like a couple of years ago. You talked about the lag effect, right? Because of the tightness of those vacancy rates, if you're buying on those properties, that 6% yield, can you expect at the end of your 3 or 5 year term or whatever it might be that there could be quite an uptick on the back end?
It'll depend what interest rates are doing, Mike. And that's the biggest thing. And human sentiment is the biggest thing in property investing, even with residential. Like the data cannot change, but because of people, it's nice weather in Sydney, people go out to open homes and buy at auctions and things like that. And that's sort of what we're seeing. So I actually am buying a little bit better than I was a year ago. And that's mainly because of sentiment. So I'm buying about 0.2, 0.3% better yield than I was a year ago. But that's just because there's lack of buyers. Because everyone's got this thing, the world roof's falling in, we're all gonna die, there's a recession coming, etc. So they're just buy. So we've got a little bit more negotiation tools there. But long term, you just focus on that. 5 years ago, I was buying stuff at 7 to 9% net yields, and people were walking away from deals being like, nah, unless it's got an 8 in front of it, I'm not interested. That property now with rental increases, we're talking like 10, 11% net yields. So even if interest rates go up to 10%, you're still cash flow positive.
We got time for one more question, Jeff? I know we've got a very strict agenda.
Okay. Just this once, Mike.
Just one, right.
We'll cut out the commercial depreciation bit.
No, you go on. Steve, the interest rate thing, you sort of were, I guess, downplaying how much of an impact you think it's going to have on prices. But the naysayers will say, well, what it does impact is people's ability to borrow and their serviceability and that sort of stuff. Sort of contrast that to people sort of saying, well, Sydney house prices can't go over $900,000 because that's like 20 times the income ratio, and where are they getting that money from? Yet it continued to go with the transfer of intergenerational wealth, so that sort of became a furphy. Is there something kind of there at play where it's kind of like, yeah, it's harder to borrow, but the money is coming from elsewhere? There's enough buyers that have got enough capital and they're getting the deals done.
There is. So like household liquidity is at an all-time high. People actually have money. The serviceability is down, but that's also a little bit of a driver to commercial as well. And I'm even seeing that with my resi business as well. People aren't copying the 3% gross yields anymore. They are looking at like the Brisbanes, the Perths, the Adelaides, because they need it for serviceability. So if you go in a full dot commercial loan and you're getting a 6-7% net, that actually gives you that borrowing capacity that where resi you wouldn't have had it. So we're getting a little bit of a shift there, but people still definitely have money. Household liquidity all-time high. Mortgage de-stress is also really low at the moment as well. So there's money there. It's just, I'm not going to pretend I can pick interest rate, and no one can. Like even the bankers can't actually pick it. So I don't know why every armchair investor thinks when they regurgitate the same thing that everyone's saying is, 6 months time, it's going to top out. Then it's going to be flat for 2 years. Then it'll come down. It's all nonsense. Like
I love the people that say it's going to go to a 10% cash rate. Like I wonder. I mean, I'd be all right at 10% cash rate, but I just think some really gnarly crap would go down at a 10% cash rate. Like
it might happen, but leaving your money in a bank as well, you're still going to be susceptible to interest rate changes anyway. So you got to do something with your money. But the thing I find, most of the people talking the loudest don't have economics degrees, but they're just reading some stuff they've seen online or from some influence, and they're just regurgitating. I can never promise capital growth or interest rates or what's going on. All I look at demand, and I know property over the last 10,000 years has always been in demand. So if I can own as much of it I can, I know I'll be okay.
In good locations, hopefully.
In good locations, as long as it's versatile. It doesn't, like, as long as it makes sense to you, you'll be right. And the good thing about property is you move with the market. Even if a recession does come and property prices drop, that is the market. Commercial and residential is a big part of the market. So you're still in line with the market. You're not becoming worse off by owning properties, as long as you can obviously handle interest rates and all that type of stuff. But long term, you'll be okay.
Yeah. I wanted to, speaking of lending and all that good stuff, could you give us a bit of an inside sort of secret? You speak to a lot of people and you speak to brokers. Which lender do you or which lenders do you sort of see? And of course, everybody's got to take their own scenarios into blah blah blah. But where are you seeing an appetite for commercial lending at the moment?
Yeah, so there's probably 3 or 4 lenders that keep popping up at the moment. ANZ are really big at the moment. They've kind of come back strong. So you're getting like 5.89% interest rates on 80% loans. So
interest only?
Interest only. I think P&I as well. And then even if you want a 65% LVR, I think it's about 5.6%. But 80%, that's quite attractive. And they pay for your valuation fee, which is a couple grand as well. So that's quite attractive. Seeing a lot of Suncorp as well for 80%. Liberty's popping up a lot, and BOQ. They're kind of the big ones. But as you mentioned, Jeff, go speak with a reputable kind of commercial buyer's agent, commercial mortgage broker, and just see what's out there. But yeah, there's a few lenders doing 80%. The rest are doing 70%. In terms of interest rates on the whole, you're talking around kind of 5.4 to 7% for full doc. And then if you're going to go lease stock, they're kind of at the 6.5 to 7.5. So that's probably been the biggest kind of shift I've seen with mortgages. In the past, lease stock used to be a big thing because rates were at like, say, 5.2% for a lease stock loan. And those who don't know what a lease stock loan is, that's a loan based on the strength of the lease. So if you've got a 5-year lease, banks will give you a 5-year loan based on the security of that lease. So in the past, when it was, say, 5.2%, and I was buying at 6% net, the property washed its own face. So it looked after itself and you could get that loan. Now that's at, say, 6.5 to kind of 7.5%, and if you're still buying at, say, 6.5%, it doesn't look after itself. So they're not going to. So I'm not seeing as many lease stock loans at the moment unless you've got a big deposit and it can kind of make sense that way. Most of the stuff coming through is full doc.
Do you would you say that if the economy in Australia starts to look a little shaky, which at the moment is still looking pretty good, like unemployment at 40-year lows or 50-year lows, whatever it is, if that starts to take a bit of a turn, do you sort of see lenders, particularly the lease stock, starting to get a little? Is there a less appetite, or like what can happen in that situation? Have you sort of seen that?
Exactly the same as residential. They're going to make sure they make money no matter what the way they can. So that's either through increasing interest rates, which we've seen they've had billion-dollar returns, or pulling back on the loan to value ratios to mitigate the risk that way. So that's normal. But like I keep saying, like, I don't pretend to be an economist. Like, it's just numbers for me. I look at that long term and I plan for the worst and hope for the best. So like that's how you should be looking at property.
There you go. Do you have any more burning questions, Mike? I want to give you the opportunity, mate.
No. I took my medicine and I've been a good boy, and I'm just letting you run the show, Jeff.
No, because I love having special guest co-hosts, because it's a real privilege to get to speak to, or to have people like yourself and like Palise and all the Toddy we had on a couple of weeks ago. So, Palise, the question, and we'll get into, because we promised about making money in this current market. But what would you say to somebody who's a person who said, I don't want to buy a commercial because prices are going down now? What's your objection handles to that sort of comment?
The thing is, you're never going to pick the market to 6 months. Like, how many people do we know at the start of COVID said, oh yeah, prices are going to grow by 20, 30%. So I'm yet to meet any investor who can pick it to 6 to 12 months. There's lots that can pick it to about 5-year period. So just buy to the fundamentals with what you have now. Make sure you're educated. Make sure your finances in order. Make sure you can handle higher interest rates, and then buy when you're ready. If you were coming 12 months ago during the heat of the market, we were paying market price. If you're coming down, it's a little bit of a softer market. We get a little bit cheaper. We're waiting out of the market for 6 months to try to pick up a bargain. I can tell you, like, literally 50% of the people I speak to say that. So where is this bottom coming when there's going to be an influx of 50% of people coming to the market? So you just buy when you're ready. Long term as well, and we'll show you through some cash flow spreadsheets as well. Like, say we buy $1 million property and it's 20 grand a year positive, and you wait and you don't want to buy it now because the market's going to drop by 5%. You're saving 50 grand, but you've lost 20 grand worth of cash flow. So you've made 30 grand. Like, it's still good money, but you're not going to change your life with that 30 grand. Having the asset that might go from 1 mil to 2 mil is more important.
What are your thoughts on it anyway, Mike? Like what you've interviewed a lot of people and on Geared for Growth. So what are your insights on that?
Some even with their consent, such as Palise himself. You know what I find really interesting anecdotally is the RBA governor has been getting a lot of hate mail about the no interest rate rises until 2024. I think he's learnt the lesson that you can't really say that in a world that has, say, Putin in it. But you know, how many people actually raced out and made a transaction or a decision based on that, right? Yes, there's a responsibility for him to sort of be reasonable with his commentary and that sort of stuff. But I don't think there's really anyone that's, you know, complaining about interest rates now going, well, I wasn't going to buy, but then, you know, Dr. Philip Lowe said this, so I went out and did it. I mean, Steve mentioned before with his spreadsheets, you know, he's going from, I can't remember the figures, 2%, 10%, but, you know, long-term average 6 or 7%. You've got to do your due diligence. You've got to do your feasibility and your cash flow analysis based on that. You know, the media talks about interest rate hikes. You know, there's another interest rate hike. It's like a politician changes their mind. They don't change their mind. They do a backflip. You know, the cash rate increases. It doesn't increase. It hikes, right? But the RBA is saying, well, we're returning to more long-term averages. And that's the truth of the matter, right? These are very, very low crisis levels of interest rates in the past, right? So I think if people are reasonable and they understand that if it's at 2%, it's not going to last. And if it's at 10%, it's not going to last. Over the long term, if you're doing your numbers on a sensible figure, then you should be okay.
Yeah, I think, Mike, we got too used to having low interest rates, thinking that was the norm and that was how you got buying property and things like that. But I'm probably going to cop a lot from the group over this. But I'm actually a supporter of high interest rates, and the reason for that is all the macro data I said before: unemployment all-time low, vacancy rates all-time low, rental increases all-time high. If we had really low interest rates, the market would be going absolutely crazy. I don't want a market that goes crazy. I don't want something that grows by 50%, then drops by 30%, then grows by 50%, drops by 20%. I like being able to calculate in the next 10 years going, cool, if I buy well and I get 7, 8% growth year on year and year as an average, that's a nice steady market for me. I don't want this volatility. Obviously, I do well because I've got a nice portfolio. If interest rates stay down, the market goes crazy. But for forecasting, planning, it doesn't make sense. We need high interest rates to stop people buying silly and making bad decisions. And that's why they're high. They're high to calm everyone down.
Yeah.
I think the other... Oh, you go, Mike.
No, I'm going to agree with you. I suppose, like, you know, we all think from our own perspective, and with your perspective of having an established portfolio already, there'll be a lot of people that are just starting the journey and they're like, I need it to drop just so I can, you know, get some runs on the board. But over the long term, it's better, as you say. And I can remember talking to buyers agents, you know, during the post-COVID booms, and I thought, oh, you guys must be loving this. Like, you'd be killing it. And they're like, we hate this. Like, we want a balanced market. We can, you know, we've got all these engagements. We can't find them the properties. Now it's like we've got all the properties, but we need the engagements, right? Like, a balanced market, I think, is better for everyone. And when you consider how big the property industry is as an employer, we kind of want normalized transaction levels as well. And transactions have been in the doldrums for quite some time.
Yeah, I was going to say, we always see like everyone whinging, oh, the boomers got properties really cheap. They had high interest rates, and they'll say, oh yeah, but the affordability was there. It was only 4 times the average household income, etc. But where I grew up, my parents didn't go on overseas holidays. We definitely didn't eat out. We had the same spaghetti meatballs every Tuesday, roast chicken Wednesday. Like they'd had to plan to buy me new school shoes and stuff like that. I don't. Maybe I'm just going to sound really arrogant here, but I've, like most of my friends, even the blue collar ones, they still go on their overseas holidays to Thailand and Bali and things like that. There's not that many struggling. And I'm aware there are some people financially struggling, so don't kill me over that. But there is a weird privilege that we have now that everything should be nice and happy and hunky-dory.
Well, I think the other thing about high interest rates and taking the property hat off, which is often hard sometimes, is outside of property prices declining, I think that there's a real reason why interest rates or cash rates needed to increase, because otherwise you start sort of seeing really working class and people sort of struggling. And I know people in that sort of boat. They sort of go to the shops, and all of a sudden, instead of it costing them $60 or $70 at Woolies, it now costs them sort of 100, 150, whatever it is. and all of a sudden they can't sort of. So you need to sort of, whilst you can't stop inflation. I mean, I don't think you've ever really seen a deflationary, like you've seen a deceleration of it. But yeah, I think that everybody in property thinks, oh, it's hard because interest rates are like, it's harder my portfolio has gone down a little bit. But I think, yeah, we sort of sometimes need to understand the drivers behind why they're trying to slow down that sort of inflation, because otherwise you'll sort of start to see a growing gap between the rich and the poor, unfortunately.
It is scary when you're financially struggling. It's because it comes so quickly. Like I even noticed, I go to the shops now and I was like, how is this $150 when I swear like a month ago it was $100 for the same thing? That's scary from a planning point of view. But that's also why I'm a supporter of like trying to take volatility out of the market and have more steady growth.
Yeah. Speaking of volatility, should we go to weathering higher interest rates? So should we? Let's see. I'm sure you get this all the time about. Let's see. Going. I think we spoke about this sort of. We touched on it, but as interest rates go up, when you sort of when the yields sort of stay at sort of 4 to 5% on assets bought, aren't you then losing money? So can you explain why you may not sort of be losing money?
Yeah, okay. You potentially could be losing money, but do you want me? I'll share some screen and we'll have a look at some spreadsheets if you want.
Okay. Yeah.
Screen.
Is it because rent increase, or like, tell me?
Yeah, I'm actually not going to take a note because that's still speculative. Even though the numbers say they're increasing, that can still stop at any time. So let's just look at the current data. Mike can have a go at me for my depreciation numbers, and we can go from there.
Let's do it.
All right.
Okay.
Actually, I'll quickly show this because I remember you mentioned before you wanted me to show you a property recent transaction.
Deal.
Yeah. So this is in Rockingham in Perth. So it's Perth. It's outskirts of Perth. It's kind of like 30 minutes south. This is kind of the bang for buck I was talking about before. Like, you go spend 1.2 million in Sydney, you are not buying an entire warehouse like this with a fresh 7-year lease. And this is just a nice little set and forget. Not sugarcoating anything though. These big ones are risky if you ever lose a tenant. If they leave, it's not a 3-month vacancy period like a little industrial kind of body corporate warehouse. You'll probably have 2 to 3 year vacancy because you need to wait for another big tenant to come move in. But then they're not too much of a volatile tenant. They'll have them for another 10 to 20 years. Like this one, they've been there for 27 years. Hopefully not. Hopefully Dulux stay there for the next 50 years. But again, prepare for the worst and kind of hope for the best. But yeah, just thought I'd show that.
So if the tenant does leave, what's the plan to, because it's going to, if you say it may be vacant for 2 or 3 years, how will you overcome that? Drop the rent?
Well, no, you can still charge market rent. It's just because there's less big businesses willing to move in. Whereas if you lose like your tenant on a little warehouse, there's plenty of sole traders and kind of versatility in that. This, you have to wait for someone to come in who wants to kind of completely paint the building, renovate it, fit out how they want, especially if it's retail versus industrial or combination of both. This is where a good property manager comes in versus a bad one. A good property manager will get it filled quickly because they'll do really strong marketing campaigns, really spam the market. Whereas a bad one will just kind of chuck it on real commercial and hope for the best. But again, you're not getting away from that. That is the risk of commercial, is having these big ones if they do go vacant. And this is how we mitigate the risk. So you try to, like, in 7 years' time on this 6% yield, like, you'll hopefully go from, say, a 70% LVR down to a 50%. So that'll take some of the market off. Hopefully the rents go up over those 7 years as well. So all of a sudden you're chipping away at the mortgage. And then that's just about balancing your portfolio. The argument here would be, if you can't handle that vacancy risk, go out and buy 2 smaller ones, smaller vacancy periods, diversify the locations, diversify the tenants, mitigate risk that way. So that's part of my job, Jeff, with the clients, is actually work out what we're trying to achieve, what their risk profile is, what their budget is, and then marrying up the right property with the kind of risk profile.
Is there a valuation premium on a tenant that has, a national presence like Dulux? I mean, if that was Palise's vacuum repairs, would it have an impact on the value of that, all lease conditions and values being equal?
Yeah, so when you're doing the comparable sales method, they try to find ones with similar businesses, similar construction costs. There's a few ways you value properties, obviously, like the build cost plus the land value, comparable sales direct, but they do look at it. The values will give you like a 20-page report. So I kind of have to do that as part of my due diligence report, plus all the other stuff like tenant interviews, but they definitely value it. Like, if this is a Bunnings, that obviously sells for a lower cap rate than a Dulux. And this Dulux will sell for a lower yield than, like you said, average Joe's vacuuming services, for instance. So you are paying a premium. I can probably buy in this suburb, and I have bought, actually, I shouldn't say probably, between kind of 6.2, 6.5%. So we took a sharper yield based on, we've got a 7-year lease with rental guarantee and a bank guarantee. So we know we're going to get those funds for those 7 years. So again, yeah, you do pay a premium, but that's also matching up with the right client. The younger, higher risk client who wants to take on a bit more risk, we might try to find those sharper yields and take on more risk that way. So it's just depends what you're looking at and where you're buying.
Can we need to make a bigger screen, Palise, if you can.
Yeah, that's right. I'll zoom in. This is going to be the hard part with us going to the spreadsheets.
People watching on their phones, are they?
Yeah, I'll try to talk it out as much as I can. So
if you're listening to the podcast, jump on our YouTube as well, because there is a lot of graphs. So it might be a little.
You can also go to my website. So go to policeproperty.com and you can actually download the spreadsheet. So anything you don't believe me, go play with the numbers yourself. Like, I'm not asking you to trust me.
Doesn't it rhyme? Don't believe Palise.
Yeah.
Or easy Palise. No.
Yeah. All right. So what I'm going to show you here is, so like a residential, the one on the left, the residential is property cash flow. This is interest only, and that's it. I can make the numbers whatever you want. So if you guys want me to change something, just let me know. But I'm just trying to choose like two $1 million properties to compare resi versus commercial. What yield do we want to go? So at the moment, I've got like a 3.9%. I've got $1 million property renting for $750 a week. Again, happy to change it to whatever you want.
I want a 7% yield, please.
No, we're not buying in Rockhampton. All right, mate.
No, you mean Rockingham? Or?
No, Rockingham. This is residential. So residential.
Oh, okay. Resi. Okay. Sorry.
This is a 3.9% gross yield. The commercial will get into the net. But again, that's a pretty fair rate for like Sydney property, $1 million, Sydney's West, for instance. $650 to $850 is a kind of a typical weekly rent. Depreciation, Mike, what do you want me to chuck in here? I've just got $3,000 a year. I've done a little bit more, or I can make for commercial, but $3,000 all right for, let's just say, a 10, 15-year-old building?
Yeah, that'd be fine. I mean, if it's 10 or 15-year-old, it's probably going to be a little bit more. We could do 4 or 5, but if we're talking Sydney, where it's probably an older property, maybe $150,000 reno, I'll give you $3,000. But yeah, 4. Let's go with 4.
Let's go with 4. All right, capital gains is just so we can do a little bit of forecasting. Again, can change that to whatever you want.
Maybe
rental management. Yeah, exactly right. But so that's actually part of the risks I want to talk about. So let's say rental management 7%. Again, depends where you buy. You can get it between 5.5% and 9% most areas. Just chose some arbitrary numbers here for building insurance and landlord insurance stuff. I think landlord insurance might have gone up a little bit, maybe $800. Rates and water, depending on where we buy. That won't affect it too much. That's just talking $1,000 a year, $1,000 or $2,000 a year. Repairs, $1,500, just allow for air conditioner, hot water system, etc., etc. And then there's nothing special about this spreadsheet. All I do is whatever loan you have. So when you can see here, like 80, 90, 100, 105, 80% loan is you fronting the 20% deposit for it. Whereas 105% loan is you're using the 20% deposit plus the 5% purchasing cost, which includes like stamp duty, legals, all that type of stuff, to buy the property. So you've actually leveraged it 105% for that actual property itself. So you can see here
you've taken cash from elsewhere.
You've taken cash from, you're paying interest on another property elsewhere. So you're still paying it. You're not mitigating it. It's still actually there. So at 4%, let's say where rates were at kind of a year or two ago, 80% loan, you're going to get $39,000 rent, going to get $4,000 back at tax time. The capital gains is an assumption. So if we get 6% on $1 million property, you make $60,000 a year. And then the outgoings is $32,000 interest. So it's basically just 80% of $1 million, so $800,000 times 4%, and that's $32,000. Rental management's going to be $2,000 to $3,000 a year. Repairs, $1,500 or whatever it is that year, and then the outgoings, council rates, water rates, insurances, bills, and things like that. So the cash return, and I know you guys have got the Deal Crunch calculator, which I stole, by the way, previously, and have used that. So download that from, where do you guys get that, Jeff? Is that just pinned on the website, on the Facebook group?
Yeah, I think it's you'd have to go to Substack or something. Yeah. We need Joe to get on here, and it's somewhere.
I'll get Jeff. Yeah, post it after. Post a link to it. So their Deal Crunch calculator, guys, is really cool. It's more involved in this. It takes into account everything and like looks at more details. This is just high level. But you can just see. So basically, your rent plus your depreciation minus all your outgoings, your interest, rental management, repairs, insurances, you're left with $70 a year. So it's a pretty neutrally geared property. So buying a 4%-ish gross yield property at the moment, you're talking kind of neutral geared portfolio. This is where residential scares me, and why I can't actually get more confident in commercial property is as rates go up. So as we go to 6%, 8%, 10%, and like I said, I've been doing this now for 7-8 years. I've been just kind of stress testing my portfolio. This is where it gets scary for me, is if you've got a 100% leveraged portfolio, 105%, you're actually 72 grand a year out of pocket. Like, that's what you have to pay. And the banks are already doing this, guys. Don't freak out like, oh my God, I'm not going to. The banks have somewhat done this. They've done their serviceability stress testing to make sure you can handle the higher interest rates. And that's why people hit the glass ceiling after 2 or 3 properties. You can see you can still make some good returns if you get capital growth, even with the negatively geared property. And this is the whole argument between negative gearing versus positive cash flow, etc. Because this property might be losing 15 grand a year, but if you actually get the 6% capital growth, you're actually $44,000 a year still positive in the green.
What if we drop that back to 4.5% capital growth? I mean, that's probably not going to happen.
Let's go 4%. No, but it does happen. So over time, like, it's actually a bit of a bell curve. You don't get on average 6%, 6%, 6%. You'll get 10% one year, 15%, then 10%, then 8%, then 6%.
Linear.
And yeah, it's a bell curve. You get 0% for, like, Sydney, 2004 to 2012 had 0% kind of on average. But you can just see, even at 4%, it just starts reducing it by about kind of 20 grand a pop.
Yeah.
So this is when people say commercial's high risk. I buy residential because I'll always have a tenant. Cool. You've got a tenant, but you're forking out quite a bit of money on average per year to hold the property. And again, I'm not against residential. I've also wrote a book on residential. I've got a large residential portfolio. The maximizing leveraging is the cool part of residential, like getting 100% loan, pulling out equity from a property that's done well and buying another, and instead of having one property, having 2 properties that are making 40 grand a year capital growth. You got 80 grand a year. You start magnifying your returns. But you can also magnify losses if the market turns. So people sugarcoat property saying it's a safe investment, which it has been for 30 years. But if times are tough, it can be financially kind of difficult. So stress test your portfolio. Download this spreadsheet, the Deal Crunch one as well. Just see what kind of interest rates you can handle, and then make your decision if you want to buy it after that. So that's the
we should have made the poster that, like, we should have made like a Survivor Palise, like putting out that would have been, damn, why don't we do that? But anyway, commercial, what does it look like?
So commercial, I'm trying to keep the same numbers. You can see instead of having 80, 90, 100, 105, I've also thrown a 70% in there, because most commercial loans, you need a 30% deposit. Same numbers. I mean, I've chosen a 6.5% rent. So that's something we can still achieve in like a Brisbane or a Perth. Again, happy to change the numbers to whatever you want. 6% capital growth. Generally, kind of, I always get asked about rental management. It depends on the size of your commercial. Generally, they're looking to make kind of 2.5 grand to 3 grand rental management as a minimum.
This is a good comment. Sorry to interrupt, but somebody said Resi calculator should also factor in increase in rent. What's it?
No, because I'm choosing a moment in time. I'm not forecasting. This is not a 10-year plan. This is for this year. If you buy that property, this is what your cash return is. For this year, this property, if you get 6% capital growth, that's what your total return is. Obviously,
year one's always the hardest, right? And that's the best year to analyze, because it'll get better over time, you would hope.
It would, but interest rates also grow over time as well. And you've got the opposite argument. If rents go down, and then if interest rates go down, it becomes even more attractive as well. But this is what you need to be able to handle, because like you said, Mike, if you buy this now and we see 10% in 2-3 years time, the rent might go up $50 a week or whatever it may be. And instead of this being 47 grand a year, it might be 42 grand a year, for instance. But again, it's just this moment in time. This is what the cash flow. That's what you need to worry about. You need to be able to worry about what you can afford today, because it might drag on for 5 years. So like I said, just always stress test it. Like for me, this is pretty common sense, but I've realized a lot of people, especially when they're buying like an owner occupier, don't really think about it. They go, oh, well, I'm going to be there for 50 years, so who cares? You still have to survive the bad periods, whether they happen now or in 5 years' time or in 10 years' time. So just forecast it that way.
That's correct, Dan. It is equity from another property.
Yeah.
Generally.
Yeah, so, Yep. So that's what 100 that means the LVR, 100% LVR. So you're pulling the money from another property using it, which most investors do. Anyone you know with a portfolio larger than 2 or 3, unless they're really high income earners, have to do this method. They have to pull out equity from one to then buy another one. But I thought I'd show you the numbers for commercial for the same one. And obviously there's a much bigger likelihood that if you lose the tenant, not getting that 65 grand a year is going to hurt a lot more than saying like residential with vacancy rates at the moment. It's always going to be tenanted, but we'll go into vacancy rates for commercial shortly. But you can just see here, let's go 80% loan, or let's go 70% because you do need to put a bigger deposit in. 70% loan, $1 million, you're going to get $65,000 of rent. And one of the advantages of commercial, as I've mentioned before, is the tenant pays the outgoings. So they pay all these kind of insurances, rates, council rates, water rates, maintenance. So you don't really have any outgoings. The only real outgoing you're going to have is rental management. Like I said, it's going to be $2-3 grand a year-ish. And then the interest that you have on the debt. So let's say 70% loan, $1 million property, you've got 65 grand rent coming into your bank account, 28 grand going out for interest, bit of rental management, and that's it. So we're 34 grand a year positive on that property on a 70%, 4%. That's a low interest rate. So don't think you're going to get that now. But just comparing that with $70 on a residential, if I can survive, if I get a good bank guarantee and a good rental bond, and I say get 3 years out of the tenant before they leave, I'm actually $100,000 up. Like that gives me a really good buffer to be able to weather some vacancy storm. Like if the tenant leaves, I've got 100 grand to pay 28 grand a year. So I can survive actually 3.5 years or just over 3 years before I actually have to start dipping into my own pocket. And that's part of commercial as well, guys. Like you need to plan your buffers. If you've got a tenant leaving, depending on what you're buying and the vacancy rates and things like that, have that 6, 12, 24-month buffer sitting there so you can mitigate that risk. But that is a bit of a light bulb moment for me. When people say, oh, commercial's riskier, it is when you don't have a tenant, but when you do have a tenant, you can set up some really cool buffers just with the property itself. But let's go to the other end of the spectrum. So 10% at 80% loan. So resi was 47 grand a year negative in cash flow. But if we got 6%, probably we're 12 grand a year positive. Commercial, 80% loan, we are only 17 grand negative per year while we've got the tenant. And then if we get the 6% capital growth, we're 42 grand a year positive in the green versus the $2,000. So we're actually getting a better return. So as you can see, the numbers are more attractive with commercial, but you have to get the asset class right. And I don't want to sugarcoat it for anyone kind of watching. It's all about buying the right one. You can burn yourself a lot more with commercial if you don't know what you're doing. So by that, let's just say this year, let's go 80% loan, 65 grand. You lose that tenant for a year, your 80 grand interest repayments you need to pay out of your pocket and you're 20 grand negative versus 47 grand negative and 12 grand positive after capital gains. So it's riskier when you don't have a tenant, but while you do have a tenant, it's obviously quite attractive. Like for me, I can handle 17 grand a year. If I lose a tenant for a year, I can handle that even at 10%. And then this is where having more commercial properties can actually arguably be a lower risk strategy, because if you've got 4 or 5 tenants and the leases are all ending at different periods, even if you say lose one tenant, you're still cash flow positive and you can look after it that way.
Talk to me though, Palise, about talk to me about what's repairs and maintenance on commercial. What about, obviously the tenant pays some of those, but with the big sort of like a big air conditioning, generally the landlord has to foot for some of that, or is that my understanding?
Depends what's in the lease, and it depends how long a term tenant they are. If theoretically the lease will actually say they're responsible for 100% outgoings, sometimes there'll be a special condition about air conditioning, things like that. I actually find the ones where the tenant is responsible for air conditioning, if it's a new tenant and they've just moved in and it blows up, they theoretically you could say, no, you have to pay it, but they're going to kick up a stink and say, well, it's unfair. You didn't maintain this property, this air conditioning properly. So you do plan for some of those. But again, it depends on what you're buying. If you're buying a warehouse without air conditioning, cool, you don't have to worry about it. If you're buying office space, that's different to a retail. Retail, they'll generally look after it a little bit better. Again, depends on size. But you sometimes have those big ticket items. one of the arguments actually is a lot of people want to buy freestanding commercial over a body corporate one.
The strata. Yeah.
But the body corporate, the tenant pays the strata. That will give you a level of security, because as long as you do a body corporate report and you see that the admin and sinking fund are really healthy, if something happens, the roof starts leaking or whatever, the body corporate looks after it. If you've got a freestanding, all of a sudden you've got an argument between you and your tenant of who's going to pay it.
Oh, Palise. Yeah. It's a good, that's an important thing for anybody considering a townhouse or a unit as well, because to double check the admin plus the sinking fund, because you can really, if there isn't a significant sort of buffer in those, let's just say you buy an asset, a townhouse or something like that, and there's only 10 or 15,000 the roof goes. Roofs can be sort of 100, 150, 200. I mean, they can be even more expensive depending on how many roofs need replacing. And then all of a sudden you can be sort of tipping in your sort of component for that sort of, there can be a special levy that needs to get raised. So that's very vital.
That's a good point, Jeff. So check most of the meeting minutes will actually show up for special levies coming up. So first check that, but do your due diligence and send a building pest inspector to go around and look at the quality of the roof and basically you've got two sets of buffers then. You've got the buffer that the building pest inspectors looked at it, the body corporate's inspected as well. There's no special levies coming up. They've got a good kind of sinking fund to look after it. And then if those costs can kind of cause issues, you can get things like building insurance and landlord insurance that cover some for stuff like that.
Yeah. So up next, we will have the commercial property depreciation corner with young Mike. He's been eagerly waiting in the wings, and we also will have hotspots as well. I mean, I know people love how much they love sort of how polarizing can be. But before we go there, though, Steve, where can people get access to those spreadsheets we just spoke to?
Yep. So just go on my website, www.paliseproperty.com, and the resource section. And as you guys know, I give everything away. Give them my book, the spreadsheets. There's due diligence checklists on there. There's heaps of there's sample property plans, and so go on there. Before we jump into Mike's depreciation, do you want me to kind of show some CBRE reports and things about vacancy rates in different sectors, or do you want to do that after?
I think we're going to do that, or I think we'll do that last, because we'll break it up with a bit of depreciation and
a bit of fun depreciation.
Break it up. But first of all, more seamlessly, I'm going to actually play your ad, Palise. So let's do it, shall we? Let's get into it.
The amazing thing with commercial property investing is that in most cases, it's cash flow positive from day one, which means that you can drive those profits towards paying down the debt. There are instances with commercial property investing where you can actually have the property pay itself off over 10 years, which is absolutely crazy. With commercial property, you get massive net yields, so you can expect anywhere between 6 to 10%. And as we've seen in the current boom, these properties not only provide large cash flow, they do certainly grow wildly in value too. Now, with big rewards comes some risk, and this is why you should de-risk your investment as much as possible. And the way you do that is with expert due diligence. And this is why we highly recommend people hire professionals to help you along in your investing journey. Steve Palise of Palise Property is one such expert. Being a chartered mechanical and structural engineer in a past life, Steve draws on his analytical and mathematical skills to do that expert due diligence for you. With 6 years experience in the space, Steve has over 1,200 property transactions under his belt. He's the guy you want in your corner, crunching the numbers and finding the best properties in the best locations, along with ensuring that you avoid the mistakes. Steve has actually even written the book on commercial property investing in Australia. And not only is it a bestseller, I believe it to be the most comprehensive in commercial property investing on the market today. He's been generous enough to give us a massive discount for our audience of 50%. So use the code OZPROP, click the link below, get a copy today, and start learning and getting on your commercial property investing journey.
So I think that's actually 100%. Apparently, Palise just let us know that he hasn't changed the code. So I think we need Joe to redo that, because it's now 8 years, I think, and also probably about 15 or 1,600.
Yeah, we're getting up there.
Yeah, but yeah. So I mean, this is the person who has been speaking to you for this time. So, but Mike, commercial property depreciation. What is it? What is it we need to know? And yeah, what are the key sort of things to consider?
You know what I really liked about this is not going to be a Steve Palise love in, by the way. I'm about to throw him some shade. I love that he put like depreciation as 0 on a commercial property because it's so variable. And if I was worried that he was going to say, what sort of deductions, Mike? And I'd have to go, oh, well, Steve, like we've got to talk about when was it built? You know, has there been any prior improvements? Has the new owner put a mezzanine floor in this warehouse? All that sort of stuff. I think the most important thing to understand is that depreciation is a bonus. It's not a strategy. Those numbers can look better or worse once you plug in those figures, absolutely. But I think that's probably the most important thing to say. Now, if I'm going to throw shade at Steve, I saw a video pop up of him the other day and I thought, oh, there he is with his beard and he does great things with a chair and a glass. But then he starts talking about tax depreciation. I thought, Jesus, stay in your lane, will you? It's all I've got to talk about. And he's cutting my grass. So, like, he's quiet now for the moment. So I'll take the floor. Of course, it depends on the type of property that you have. I mean, what residential and commercial have in common is there's two main buckets of depreciation. There's the plant and equipment items, Division 40. There's the structural components, you know, the hard assets, the concrete, the timber, Division 43. Now, what's distinctly different with commercial is that the legislation changes that happened in the budget speech in 2017 don't apply. So the short story to that is that second-hand plant and equipment items will give you depreciation deductions in commercial, but they won't in resi. You could have a 6-month-old property, buy that and get 0 plant and equipment deductions. It's really unfair. With commercial, it's not the case. We'll work out whatever the residual value is and you'll be able to claim it from there on in. The other thing to note is that the ATO effective life tax legislation, which comes out normally a week or so into July each year. The current one is TR 2022/1, if you want to look it up. It has about 281 pages. And now about 4.5 of that relates to residential property. The rest of it is commercial. So such a huge list of plant and equipment items for commercial property. And every year they're adding new things. So wood and upholstery manufacturing is a new category. Casino operators is a new category this year. So it's nice to know Mr. Packer's going to get some extra deductions. So there's just so much complexity to commercial tax depreciation. But what I think you should know is that the cutoff date for original claims on the building structure is different depending on the asset, whether it's manufacturing or whether it's a warehouse, whether it's travel or accommodation. There's different rates and things. But probably a good date to remember is 1982. That'll cover most bases. So if it's built after
3 years earlier.
Yeah. So if it's built after 1982, there's probably going to be some original building claim. But then if it's built prior to 1982, it begs the question, well, how is it functioning as an income-producing property? Like a warehouse could be built in the 60s and left untouched, and there could be 0 depreciation on it, right? But you are going to see upgrades in fire services. So a warehouse will often have, might have dock levelers. It could have ventilation fans. If there's an office component, it's going to have carpets and partitioning and blinds and security systems and things like that. But when it comes to commercial, the best deductions are obviously in newer properties, but properties that have the most stuff inside them. So a warehouse is not as good for depreciation as, say, a pub, because per square meter, there are more widgets in a pub than there are a commercial property. I know that's terribly scientific and people can't keep up, but we'll try and keep it. We'll try and keep it at that level.
So we're buying a pub, are we, Palise? Or which pub are we buying?
No, do not buy a pub. Lenders hate them, and they're very hard to make profitable. And yeah, just stay away from pubs in general unless you know what you're doing. They're a niche in themselves. One point, Mike, that you mentioned, like the good thing with commercial is if you're a tenant of a commercial, you still get to claim the depreciation. So you can be operating your business there and claiming all the building and stuff as well as the business, which is quite important.
Yeah, so when we go and we do a depreciation schedule, we're often doing more than one at the same property. Now, it could be for someone that has an interest in both companies. So it could be their self-managed super fund that owns the business. That's a relatively common thing to happen in commercial. And then their business actually trades out of the premises, and that business may have done a fit out. So they can claim all of the fit out expenses, and they might have, you know, tables and chairs and reception desks and even computers and photocopiers and, you know, even things scientific like autoclaves. You can get really crazy with it. But the self-managed super fund might just own the building structure and say the fixed plant and equipment like the security system. So yeah, absolutely. Whether you are buying, say, a leasehold entity, like you could buy a leasehold motel or a freehold motel, there's depreciation for both entities.
There you go. Is there
what I really like, Mike, you use the word, and people forget this. People think depreciation is part of your cash flow. Like you said, it's a bonus. You're getting it. And I hate to tell people, you're getting it because the property actually is depreciating. Like if you've got a residential property and you depreciate the structure, in 50 years' time, that building is not worth the same. You've actually lost money. You have to build another one. You have to fork out money. It's supposed to be a fair one. You can obviously flim-flam the system to try to get some good returns, but it's because you're actually losing money. That's why you're claiming it back off your income.
Yes, and really every widget, whether it be a brick or let's say a de-stemmer in a winery, has an effective life given by the tax office. Now, we're more commonly used to seeing plant and equipment effective lives. Let's say carpet in a drinking area of a pub is 5 years, in a dining area it's 7 because people spill less shit. But the building structure itself will have a 40-year effective life as well. So that's basically the tax office saying that by the end of that period, the building will have reached its functional obsolescence. It sort of needs to be replaced. Now, it could still have a market value. So a property that's 50 years old as a warehouse is not going to be worth nothing. But from a depreciation point of view, it has zero depreciable value.
There you go. The
main reason for that, Mike, is basically, from my understanding. Oh, sorry, Jeff.
There you go. No, I was about to move on the hotspots.
I was going to say, yeah, that generally comes because a 50-year-old warehouse is not worth more than a 60-year-old warehouse. They just kind of both get put in that category.
Yes. Yeah. Yeah, so 40 years, I mean, there are some weird nuances. I mean, there used to be things like strong room doors in a bank, which had 100-year effective life. So we're talking depreciation rates of less than 2.5%. But really, the longest effective life of any structure or plant and equipment is normally 40 years. There's not really much that exceeds that. So yes, after 40 years, it's going to have no depreciable value. And from a utility value, as you say, it could be built in 1910 or 1978. It's still, it's still forming the same sort of function.
Can I ask a bit of a fun question, Mike? What's the most depreciation you've seen on one of the properties you've inspected?
Gee, that's a good question. One springs to mind that was a warehouse in Queensland by a major distribution company, and that had over $3 million worth of deductions in the first year. We also did a couple of the landmark hotels in Surfers Paradise, and they would have been in the millions of dollars. I should do some research on that. I tend not to share that as a marketing piece because I sort of don't want to say, hey, ATO, this is how much revenue we denied from you this year. Yeah, certainly I've seen over $3 million, and I've seen over $1 million in a year in a residential property as well, which is pretty astounding.
Wow. You might get a quick audit come your way, Mike. It's like, oh yeah, a random ATO audit has hit MCG depreciation after you.
We're ready to go, mate. We stand by everything. There's also weird nuances around, some of the temporary full expensing and income instant asset write-offs as well. So we did a leasehold winery in the Hunter Valley, and there was about 550 grand worth of equipment, and it was an immediate deduction. So 550 grand deduction year one and nothing every year thereafter.
But just keep in mind, in my understanding of this, and I've recently had to do a tax return of selling a property, you have to pay back most of that or all that depreciation when you sell a property. Is that right?
Steve said fun, and now you're talking about paying money back, Jeff. You're just
bringing down the mood. Sorry. Yeah,
Yeah,
it's all about hotspots soon, but yeah.
yeah, no. So what happens is that the Division 43 deductions that you claim impact your cost base for capital gains tax purposes. So if you think about a residential property, which is probably a bit easier to understand, let's say you bought it for $1 million and you sold it for $2 million. Well, you've got a $1 million capital gain. Now, over that period, if you claimed $100,000 worth of depreciation deductions on the structure, then that actually makes your cost base $900,000. So you're going to be paying capital gains based on that amount. But, you know, in the resi space, you've got the 50% exemption if you're holding it for 12 months, and then it's just at your marginal rate. So this is a question that often gets kind of heckled at me in presentations. Oh, that's all very well, but you've got to pay it back. Well, you're not paying the whole amount back. You're paying a fraction of half of the amount back, and the time value of money has to have a consideration, especially in the market that we're in now. And when we look at Steve's spreadsheets, we can kind of see, well, you know, he hasn't forecasted in rental increases because, you know, we wanted to sort of post a snapshot in time. And I think it's probably the worst point in time, right? Because you might pay down your loan and your rents might go up. But, you know, for any investor, whether resi or commercial, the hardest time to normally hold the property is day one. So the dollar that you get today is better than worrying about a fraction of that dollar that you might have to pay back in 20 years.
Well handed, Mike. So on that note, commercial hotspots, Palise, I'm sure you've been excited, and I see you did a report on this. So I think this is probably straight from the report, is it? Or did you do this especially for us?
No. So I'm like, whenever I tell people like vacancy rates an all-time low, and we see a lot of spruikers and that saying that type of stuff, like, oh, now's the time to buy, etc. I just get the number. I'll show. Let's present the screen, and I'll show you the reports, and you can download them. Type in CBRE and whatever report you want. If you want industrial, say industrial vacancy rate report, and you can see the halves of the years from every year what they've reported. You'll have to take it with a little bit of a grain of salt based on what you're buying, because a lot of these reports are for the big stuff. So you're talking like the really big. Oh, there we go. Can we see my screen? We're all good.
So are these the hotspots, or is this where to find the data? I just want
where to find the data, which is effectively hotspots. But I can answer what you want, and you guys just pester me with any questions that you have. So tell me like, oh, what do you like in Brisbane and Sydney and blah blah blah. And I'm more than happy to share. I'm an open book with this stuff.
What are your thoughts on Tasmania?
Very small market. Like, even though it's a capital city, it's still quite a small area. And again, Jeff, are you talking retail? Are you talking office space? Are you talking industrial? They all have their own nuances. And Tasmania actually surprised me is left out of the stats, the same as Darwin, because they are small. They've got the word capital in front of them, but there's bigger regional towns you should be worried about. But the one I want to show people, so this is commercial vacancy rates over the last kind of literally 3 years. Like, the graph is quite scary. I used to say 5 years ago, sub 7% was a kind of a vacancy rate I'm willing to cop. And now it's really low. And so when people say, oh, yeah, the property's going to sit there vacant, they're getting tighter and tighter. So like you can see here, Sydney, 0.2% vacancy rates. People say that's a really strong residential vacancy rate. And we're getting that industrial. And then you can see like Brisbane, 0.5, Melbourne's the highest, but that's still really low. Adelaide, 0.8. Perth, 0.4%. So there's actually a genuine kind of scary like lack of supply in the industrial sector at the moment. And that's probably going to continue because build costs have gone up, and it's not really economical for developers to actually do a development project at the moment. So for the next, again, this is a forecast for the next 3 to 5 years, like industrial might be a really strong asset. And that's why I know with this type of tightening, we are going to keep seeing rental increases, and that's why long-term I'm not worried about this. I know in 5 years' time, we're going to be in a good spot with the industrial sector. But like everything, it depends what you buy. Like this Brisbane, for instance, buying something right on the outskirts of Logan is different to the inner CBD, and then that's going to be different for Gold Coast, Sunshine Coast. Funnily enough, Sunshine Coast, here's a hotspot for you, Jeff. Sunshine Coast and Gold Coast, tighter vacancy rates than Brisbane. So you can talk capital cities being a good spot. Some of those regional lifestyle areas, Really, really
about-
attractive.
What about Wollongong, Palise? Is Wollongong any good, or you just wouldn't go there?
No,
Wouldn't bother?
Wollongong's quite tight. I haven't checked the data just from the properties that we've kind of seen there. Again, you're talking. I imagine it's probably similar 0.5, about 1 to 3 month vacancy. Those fringe ones, you need to be very mindful of what future stock's coming up. So anywhere like Sunshine Coast, that's had a really big population growth in the last few years. I think I read, was it 9.4% last year or 9.6% for Sunshine Coast? But they're planning future stock. However, I went to the Sunshine Coast Town Hall meeting for commercial development. What was that, 2021? And they've run out of stock that was supposed to last until 2030. So what they thought they built was going to last till 2030. They've filled it up. So there's actually, in a lot of the areas, those well-confined areas, there's a waiting list for industrial property. So there's almost zero vacancy rate. Like basically, as soon as it comes up for tenancy, you get top rent, top tenant straight away. So this is why I'm not fearful. And when all these armchair investors just give it to me being like, oh yeah, your property's going to sit there vacant. Cool. If you're going to say that, show me some data of why it's not. And your argument can be, and I'm fully support this trend might go back up to this point in time. And that's case.
Well, yeah, that's a question that's popped up. Given the recession, I mean, I don't know. I think it's. I mean, I'm not going to make a wholesale statement and say that we won't have a recession in Australia, but I think our economy just seems very strong. So maybe we don't have a recession. Like, I mean, interest rates are somewhat sort of. Do you think that'll increase? This is only for industrial, right, Palise?
So with recession, the world keeps turning. You still need all those supplies, fabricators, and things like that. What generally happens is, as the recession happens, vacancy rates will go up a little bit, but rents will drop. And that's what we need to take into account for when we do those cash flow spreadsheets is the numbers, like Mike said, we're looking at today's snapshot. Interest rates can go up, they can go down. Rents can go up, they can also go down during a recession. But you've got to do something with your money. So if you're going to go buy a business, you got recession. If you're going to leave your money in the bank, what are you stockpiling? Like, I'm not giving financial advice. I'm just saying these are the numbers. No matter what you present, like the numbers are the best they've ever been. And then people's first reaction is, oh yeah, but it's going to turn bad. When it was bad, they were going to say, oh, it's going to get worse. And now it's better. They're saying it's going to get worse. So they're always going to, and you should be doing this. I'm not criticizing that comment because that's what I do personally. I look at, okay, how bad can this get and plan from there. But you're always going to need something like an industrial property. You don't always need an office space, but industrial properties have a land component, which is useful. It's always going to have some form of versatility. So yeah, feel free to download these or shoot me a message and I'll send them to you. I'll email them to you as well.
So Jackson, I might get you to clarify this comment. So CBD areas of B grade city. When you say B grade, do you mean regional or what? I'll get Jackson to say what he means by that. But Mike, what are you sort of seeing? Like, because you would do a heap of these reports. Like, are you seeing a lot of newer stock being built? Like, are you sort of seeing forecasting it may increase or what?
No, I think construction activity is in the doldrums across the board, residential.
Too expensive?
And commercial. Yeah, I mean, interest rates is part of it, but construction costs and the availability of trades, we've been talking 20% increase in costs in the residential sector in 18 months. I think, we're going to have quite a supply crisis in the residential side of things, which is sort of tends to be where more my gaze is. But I certainly don't see swathes of commercial property being built. I think Steve gives really great general advice about, the areas where there is the ability for stuff to be built, like the high-rise office style things, or if you're looking at areas that have kind of like a green zone around them where it can be built. But I don't see any huge incentive at the moment for developers to be active in that space.
I want to circle back to this one because we did speak about the Gold Coast. I don't know whether you'd say Gold Coast is, I mean, it kind of is regional. But where do you sort of see some value outside of the capital cities, Steve?
So regional is a tough one for me. So like most people know me as the low risk investor. I still want capital growth with the commercial. And as we saw in those cash flow spreadsheets, that's where you really maximize your returns. So, and we had a bit of a chat before we jumped on live was you got to make sure that the regional area in quotation marks still has really good fundamentals, capital growth prospects, not too much land that's going to be released, and you kind of get that scarcity factor. I like the fringe cities. So the ones that are still within kind of capital cities where big businesses can still go buy their big warehouse or have their kind of thing, but pay a fraction of the rent and still get to the capital cities. Newcastle, Central Coast, Wollongong, Sunshine Coast. What are we going? Gold Coast.
Do you like Geelong?
No, I don't mind. Geelong's are quite sharp there for what it is, and a lot of land to be released. So, there's some there. But for me, it's just weighing up that bang for buck. And this, I've got it up on Sydney. Looks like a really great spot, but most of these areas you're buying stuff at 4%, 4.5% net yield. Is that a better investment at a 6.5%, where you can see here? Yes, it's slightly higher, quite proportionally not that much different, but you're getting a better return. You're getting kind of 250% more rent for your money, so that mitigates the cash flow risk. So there's all that. So this is so you can feel free to download these reports, or I'll send it to you and have a look at these are the areas that are performing well, aren't performing well, and then make a decision from there. I like capital cities and regional towns where I buy in an area that's surrounded by residential. So when I look at the numbers and I talk to town planners and I look at the forecast and what's being built, I can at least kind of give some assurance of this is where I think it's going to be in 10 years' time, because they're not building any more stock. The population's growing there. We should have some safety long term for it.
That's interesting. You've got 2% vacancy rate in the west of Adelaide. Is that that's kind of like your Port Adelaide, you're out that way. So they've built some. There must just be a good amount of either supply or just not enough demand out that way.
Yeah, so Perth's a surprisingly small city. They've built a lot of stock in the north. So that's where all the newer states are. So that's probably driven that down, where the businesses, unless they're a little service-based business servicing that little area, like a little quick supply company or something like that, they just move 10 minutes away to that north and outer north area and pay 30, 40% rent. But again, the numbers are still really, really tight. 2% is, do you remember 3-4 years ago, Jeff, we were telling people sub 3% was a tight vacancy rate for a residential. And now people still give it to me saying, oh, probably is going to sit there vacant. And I've got better numbers than residential most of the time.
Yeah, having conversations with agents day in, day out now in Perth in particular. They're like, oh, you just can't rent anything. It's just it's insane. I'm sort of hearing similar things in Adelaide as well.
Any business owners that call me up, they're struggling. They're getting me to try to find properties for their businesses because they're really struggling. So we have to leverage some off-market opportunities and stuff like that for them. It is tough. It is, and this is what I mentioned earlier in the conversation, is buyer sentiment is going to be the biggest play over the next year or two. Again, assuming interest rates stay where they are. If they keep going up, buyer sentiment might change. If they go down, the market will go absolutely crazy, is my prediction. But as I keep saying, buy it based on 10 years, not based on a year. 5 years ago, you should have been saying, what happens if interest rates go up to 8%? What happens if we see a recession? You do all those stress tests anyway. But this is a really cool report if you're looking for some numbers, and they release it every 6 months as a minimum, sometimes quarterly. So you can read up. Like I said, look at the size of them as well. They look at different size warehouses and class it in regards to different size. And they look at net absorption, which is basically net absorption is the amount of square meters that got leased that year versus the amount of square meters that got vacant that year. So that's kind of like a vacancy rate, and compare it that way. Do you want to have a quick look at retail and office space? That might give some interest there.
I want to look about. You've got I see you've got that commercial property hottest 16 picks. What is that locations, or is that sector?
No. So that's locations and sector. I've just chosen around Australia. So again, go on my resource section of my website. I've got 16 kind of spots that I think are going to perform really well. I've tried to. Sorry, was that?
Could you give us 3 of those ones, free ones that we haven't really spoken about, just so we can give us a little teaser?
I really like actually, let me go to the graph. So there we go. One of the areas.
Sorry,
what was that, Jeff?
Sorry, you go. I was going to say, Mike, what are you sort of seeing up there in the Newcastle sort of region? It sounds like it's business is going very well in Newcastle as well.
Yeah, I mean, I think Newcastle probably is worthy of an update in people's minds. I mean, I'm not a proper Novocastrian. I came to I guess it's more the Lake Macquarie region in 1997. So unless your placenta hits the floor of the Mater Hospital, you're not a true Novocastrian. But it's not the BHP mining colloquial blue collar place that it once was. It's gentrified. It has hipster coffee shops with bearded chaps and pants rolled up waiting for the floods. It's got an inner city. It's got an inner city brewery. I mean, there's a gin distillery in in Carrington, which is a really industrial area. So it's changed a lot, and it is a reasonable commute to Sydney, but people do it. But there's a lot of value in Newcastle that people haven't been getting in Sydney, and the Central Coast has been booming, and Newcastle's just perennially popular. And this weekend we've got the supercars as well, so that's another big advertisement for the city.
Yeah.
One of the things I find is every Sydney person, we've seen this with residential as well, wants to buy Wollongong, Central Coast, Newcastle, Sydney, because they think that's the best location and they can go drive and look at the property. But I hate to tell them, the warehouse they look at doesn't care that they've seen it or not. It has nothing to do with the numbers. It's just a bit of self-assurance. Same thing as the Melbourne people always bring up Geelong and those areas and Bendigo and stuff like that. So, but first hotspot, Jeff, that I really like, bought a couple in Brookvale on the northern beaches, and these numbers back it up. There's some really cool stuff there. Again, there's a waiting list and the main reason for that is there's a lack of supply, because you've got the ocean on one side and it's completely filled in. The closer you go, the closer you get to the city, so it becomes more densely populated. Some really good demand in that kind of Brookvale area, where that services a huge region of the northern beaches as well. And there's a lot of local kind of service-based businesses, the builders, fabricators. People love being there because of the lifestyle. And just in terms of money as well, most people there have done really well with property and incomes. So there's still kind of a good wealth barrier there where they can keep building new stock and things like that. So northern beaches, you can actually, if you buy well, you can get to 5% in front of the number. I bought a couple at 5.2, 5.4% in the last year. So really like that as an area. Brisbane and Perth, depends on kind of if you're looking for more high yields. So just go to Brisbane. Up in the north, so kind of Moreton Bay regions and areas like that, you'll kind of get that 6 to 6.5%. So really like the Rothwells and Callingers and areas like that. If you're chasing yield, if you go closer in the city, you're probably getting closer to 5.6, 5.8%. But again, industrial stock there's quite nice. And then Perth, if you're really chasing yields like that Dulux one I showed you, like Rockingham's really good. Sites like Wangara, there's another really good site. And they'll give you comfort in the numbers there. So for industrial, that's where I'll pick. I think we'll jump into retail, and I can kind of give kind of some picks there as well. And then even office space, there are some good areas, but again, just be mindful of the vacancies.
Yeah. Yep. What do you like? What do you like in retail?
All right. Let's make sure I got the right one open. That's industrial. Let's get rid of that one.
Logistics vacancy. Here you go.
Growth, construction. This is office space. Retail.
Wow, off the back of construction. Rental growth accelerates. Yep.
Yeah. All right. So let's just go retail. I want to make everyone aware the stats on retail mean basically nothing to the everyday investor. And the reason I say that is most people aren't going out and buying a shopping center. They're not buying a Westfields and areas like that. You are most likely, if you're just a typical investor like me, you're buying the local neighborhood kind of shop. And then that's what's happening in the Westfields in the CBD does not affect your local neighborhood shop. And we saw that during COVID. The retail spending in CBDs went down, but then went up in some of those kind of neighborhoods where people started working from home. So you can still have a good outcome. So these numbers are a little bit more scary when you see like kind of 8 to 20%. But again, that's big shopping centers and things like that. There's actually been more of a boom to, and this is why industrial's taking off, is to that e-commerce where people buy online. So that's helped it there. But it's also helped local communities where people would go into the CBD to get their hair cut and do a little bit of shopping. Now aren't going in as many times, and they knock off work early on Monday when they're working from home and go get it done at their local. So like I said, don't get too scared by these numbers. You need to assess what you're buying, where you're buying, what area it's servicing, what the foot traffic is. And that's harder to do with retail. So like with industrial, I mentioned before, you've got lots of comparables. You've got all the warehouses in the same complex, the adjoining complexes. You can look at the vacancy periods. But if you're buying, say, a little cafe and it's in a retail strip of 10 and there hasn't been a vacancy for the last 5 years, that is a complete thumbsucker what the vacancy rate's going to be. You're going to have to talk to some property managers on the ground and find out kind of who's been sniffing about. You're going to have to try to maybe find something similar in an adjoining suburb and look at how long those ones went vacant for. You'll track back through the history of that property. So there's less assurance on the smaller ones, but the tenants are stickier. So what I mean by that is if a hairdresser moves into a premise, they don't leave if they do really well. They normally open up another hair salon elsewhere and have 2 salons. Whereas in industrial, if that business does well and they outgrow the space, they move to a bigger warehouse. They don't open a second warehouse. So on average, you'll get a tenant for a successful retail longer. Like on average, you'll have 7 to 15 years for the tenant. However, if you lose them, because you have to wait for another long-term tenant with fit-out costs and incentives to get them on the lease, that'll probably be, again, depending on where you buy, 6 months to 24 months. So it's just balancing that risk versus reward. But again, what I like about these kind of reports is you can kind of see where people are spending. And it also actually surprised me, helped me with my industrial analysis because I can look at like online spending and things like that, and what areas are doing well, where the shifts have been, things like that. So encourage you guys to read these reports. They're really good, kind of high level, and it doesn't take you long. You spend 5-10 minutes and you get a good overview of what the last 6 months has done. So retail, to give you your hotspots, Jeff, I like the areas where we're seeing really big population growth and there's a lack of supply. So this is where I'll probably go even more regional. I've got no issues with buying in the Tamworths and the Coffs Harbours and the Margaret Rivers and the areas like that, assuming you're buying something where there's a lack of supply. So if you get on the main street and they're building out around that, they're not going to build another main street. So you've kind of captured that. If you go to like Sunshine Coast and you buy like on Mooloolaba beachfront, that you've got the scarcity factor because they can't build it out. You're always going to be on the beachfront. You're always going to have the cafes and the board shorts and bikini shops and all that type of stuff. That gives you the kind of comfort there. But again, do your due diligence. But for me, sometimes retail in regional areas is lower risk than a capital city. Like as we saw in capital cities, if the city goes really quiet, you don't get the foot traffic anymore. But in a lifestyle area, they always have the foot traffic, assuming there's not kind of like a pandemic. And that's where another risk comes. If they stop getting tourism, like Cairns and Port Douglas, that saw a decline, obviously during COVID when the border shut and they weren't getting their big portion of international tourists coming over for the Great Barrier Reef. So you just got to be mindful of the market you're in. If it's seasonal as well, is it a summer location? Is it a winter skiing location like a Jindabyne or something like that? But I really like retail in regional towns because it can offer a lower risk than kind of buying capital cities.
Have you got any insights from about Kempsey? I mean, that's an interesting location. I mean, have you?
No, I haven't actually bought in Kempsey for retail. I looked at the industrial. There's some kind of good industrial there and you get some good yields, but there's a bit of stock. Actually, when I used to be a mining engineer, we actually had a fabrication workshop there called HF Hands. So they went there quite a lot. Again, that's heavy industrial type stuff typically. So that's where the fabricators go that service kind of the regional areas, the mine sites and things like that. You've got a property in Kempsey, don't you? You've got some affiliation with Kempsey, don't you, Jeff?
No affiliation with Kempsey. That was that was a question from the audience.
Okay. Get them to send me an email if you want. I can send them whatever data I have through my kind of logs from looking at the industrial, and that might help.
There you go. So yes, what is it? Steve at paliseproperty.com.au or something?
Yeah, just no.au. So there's Steve at paliseproperty.com.
Taking over the world.
Yeah, or shoot me just a message on Facebook on Messenger, and I'll get back to you.
Don't like that.
Yeah, that's fine. All right, so office space. We obviously know that vacancy rates are really high because of COVID. People working from home. I mentioned this earlier as well. So there was a bit of stock that came on the market, kind of in Brisbane and Sydney. So that actually increased it. So before COVID hit, they just released these big buildings, and then all of a sudden COVID hit, so they weren't getting taken up. So let me just have a look. Net face rent. So this has got percentages there. Where is it? Sorry, I haven't looked at this for about 2 weeks. So here we go, vacancy. All right, so you can see here, we're kind of in that 10 to 15% kind of price point for vacancy. And you can see a lot of areas that's kind of Actually, weirdly enough, gone up in the big capital cities. So Australia as a whole, yet, but Sydney, Melbourne, gone up in the last kind of 12 months, sorry. And then weirdly, some of the kind of like slower markets, Adelaide and Perth, actually tightened. And again, don't get carried away thinking, oh, that's awesome, it's getting sharper. We are talking the difference between 16% and 14%. So instead of it being vacant for, I don't know, a year and a half, it might be vacant for a year and 9 months. Like it's still quite negative. Canberra, very dependent, obviously, on kind of government, and that's where all the workers are. They all work for the government, so that's less kind of volatile there. They keep paying their rent, and they keep it tenanted in quotation marks, even if people are working from home. But office space for me, mindful of oversupply. You can always keep building up. Industrial and retail, you can't. Like retail, theoretically, you can build a shopping center, but like for the ones that, like I said, most people are buying the one-story retail strips, that the people don't want to go up to the second story unless it's like a medical center or a dentist or something like that. The main foot traffic, people are lazy. They want to walk straight into it. Industrial, you can't build up for heavy industry anyway, because structurally it's just not economical to build 3-story warehouses with 500 to 1,000 kilopascal kind of load ratings. So that you've still got the land component. But office space, they're designing for minimal workloads, and they can build 20-story skyscrapers. So that's why the vacancy rates will rarely get really low, especially in this working from home culture market. 15 years ago, some areas were really tight. Like in the capital cities, it was hard to find office space. But now the world's eyes are opened a little bit. They're open to kind of those, it's called the hub, the spoken hub model. So basically a lot of offices are opening little satellite offices, which is changing it from big floor space to small floor space, more co-working, et cetera, et cetera. But yeah, for me, buying an office space is the same as buying a high density off the plan apartment. You're kind of paying for a lot of concrete in the sky and a lot of money.
What are your thoughts on the work from home situation, Mike? Are you a pro work from home, and do you think we'll ever go back to pre-pandemic?
Somebody said, actually, I was listening to a presentation by, I think his name's Tony Nash. He was the Booktopia founder, who's the outgoing CEO. And he said, if you want a job, like, you work from home, but if you want a career, you go to the office. I think what he's saying there is that there's a certain dynamic in and around a joint workspace that enables you to show what you're capable of and to learn from other people. And I don't think work from home is going to solve that sort of thing. I think there are certain industries where that flexibility was a forced experiment, and they will stick with it to some degree. But for the most part, you know, in the anecdotal chats that you have with coffee shop owners and Uber drivers, you know, people are coming back, and the migration to the regions for the lifestyle and the work flexibility is starting to be negotiated on. If the unemployment rate was another 2%, I don't think that'd even be a conversation. It's just that staff
come back
now
to the
have a little bit of bargaining power, right?
Yeah, one of the points to note, Jeff, is if you're working from home full time, you want to hope you have local knowledge, because if you don't have local knowledge, there is no more incentive for that company to hire a local Australian. Then they can literally look around the world. So you want to hope you're really good at your job, because now you're competing with the entire world.
I think I'm fairly safe with Joe, but we'll see how we go. Maybe they might get Chat GPT to understand how to buy property more. You never know. I could be in trouble. But that's interesting. So, Mike, you came on, I think, a month or so ago, maybe 6 weeks, and we spoke about some of your predictions around. Do you still feel the same way about where the cash rate's sort of heading? And
I remember seeing your face. It was contorted in such a way that made me believe that you were on a different trajectory. I think I said at the time that I see a maximum of 2 interest rate increases. I think we've probably had those. I've had to revise that position because I think there's at least one more. The RBA are terrified of this wage price spiral as much as they are about inflation. But, there's so many indicators that are lagging. And I think, like Steve was talking before about, some of his blue collar mates, These are sort of the same people that are complaining about interest rates, but they've just got back from Bali and they've just bought a new Land Cruiser. People have had a little bit of cash and they've thrown it around. But some of the metrics like time to buy a major household item have dropped significantly. So I think we're going to start to see the impact of this unprecedented rate of cash rate rise. I think we've probably got another one to go, but even in the meeting minutes, it's starting to soften the rhetoric around the increase. So yeah, look, I'll concede that I probably thought there was about 25 basis points less than I think there will be, but I don't think we're going to see upwards of 50. I'm predicting 25, but like Steve said, it's crystal ball stuff, right?
Yeah. And the other interesting, I love Pete Ward's and stuff. I saw on Twitter he did a consumer confidence has dropped quite a bit as well, back to sort of So that's sort of saying it's bullish for RBA not continuing to keep increasing the rates. So
they needed to see that, right? Consumer sentiment, the consumer confidence, the time to buy a dwelling index, they're all very, very soft. Some of those metrics are softer than GFC times, right? So the RBA, I think we're hoping and praying to see some of that coming through. So we're seeing that coming through. And I think Steve sort of said, look, if interest rates drop, I think, sentiment's going to go through the roof and we're going to have a massive run on property, which, is that peak and trough thing that we were sort of trying to avoid. I can see that playing out in all honesty. I think, the pace of increases, we're going to see that happening and it's going to be delayed and it's going to hit things pretty hard, which is the idea of the RBA, right? They want to get ahead of this inflation. But all the fundamentals are so strong. Dwelling approvals are in the toilet. New finance commitments for new homes are in the toilet. I'll come up with a different expression than in the toilet in a second. Vacancy rates are so low. We've got, international migration. There's so many positive metrics around the property market. The unemployment rate, which is predicted to increase, but still going to be quite low. There's so much pointing at the property market going through the roof if those interest rates come back and people can buy the property. So I guess I'm pretty optimistic about property prices in the next couple of years.
It's kind of a little bit scary because in fairly affordable locations at decent sort of price points, it's already pretty tough. Like to be able to, you have to be very quick. You have to be on it. You really, like, you can, in certain locations around Australia, you can look at a property listing in the morning and then in the afternoon it's gone. Like if you're not calling up and saying, hey, look, what's going on with this thing? Like let's kind of consider what sort of price we'll buy, that sort of stuff. If you're not doing that sort of, so I really feel for the average investor how they're sort of doing it, and if they're buying in locations where that's not happening, I'd just be a little bit concerned, a little bit cautious, and not to say you can't still make money in those, but just interesting. Sure, you go, Steve.
I actually had a chat with Joe when we were getting a beer when he was over here about that over here, where Australians, we still have this mindset that home ownership is a right. And I agree, it actually should be. In London, for instance, it's not. Your parents will sometimes pass their rent onto you, not the property, but that's because it's a much more established area. The buildings are 300, 350 years old. So they've got that kind of old wealth that's come through. But from what I'm seeing with vacancy rates being so high and the prices keep growing, I actually think a big portion of the market will be pushed out and life will become, you work, you pay your rent, and then that's it. So the home ownership is off the table. And I agree, Jeff. I'm actually quite scared. If you own property now, you're in a really good spot. And like I keep saying, if you own a bit of land, at least you've got something long term. You're going to have always somewhere to live, something to kind of give you some income and kind of plan from there.
Yeah, there we go. Shall we get to some Q&A? Who doesn't love a bit of Q&A? So, Steve, you got a flight in a couple of hours, so better get going. So what amount is a good starting point? This is the age-old, like you think 300,000, didn't you say, Steve, or 3 or 4? But I don't.
It depends. It depends what you're trying to achieve with the purchase. If it's just you want to buy a little cheap property just for a little bit of cash flow, you can get a nice little warehouse in Brisbane or Perth for 300K. The negative with it is you're not going to get like a 5-year lease. It's going to be a sole trader who just works on his car or leaves like, I don't know, this has a little bit of distribution business from there. They're only going to sign 12 and 24-month leases. They're also going to be more volatile because most small businesses go one or two ways. They either outgrow the space and they move on, or they close up shop. So you're going to go through a new tenant on those every like 3 to 5 years, but they're a nice little way to get into the market. The proper question should be, is waiting to get a 500 grand one a better property, which you will start getting the 2, 3, 4 year leases with those. The answer is yes, if you can do it quickly. So if you can save up for a year or two, then get into a slightly better quality asset, then yes. If it's just to get into the market and kind of dabble your toe, learn the ropes, then you can still buy cheap. Anything less than that's fraught with risk. You're going really regional, or you're going like a retail or an office, but just buying a little warehouse somewhere is not a bad option.
Do you buy much in Penrith, Steve? Because somebody said 600. Like, what sort of price points typically? I mean, I don't know if you buy that much.
Penrith is not a bad spot. It's just the bang for buck. Out there, you're probably only getting 80 to 150 square meter warehouse. So a little bit more one-dimensional. Whereas if you go like a Brisbane, spend 600K, you can get a 250 to 400 square meter warehouse. But Penrith's actually a good spot. I actually personally own some property in the Blue Mountains, and that's using a lot of the warehouses in Penrith because that doesn't have its own quite big industrial estates.
Be careful of saying the Blue Mountains is Penrith, Steve. Penrith is not the Blue Mountains.
No. So it's not. I know it's not the Blue Mountains, but that service is the Blue Mountains. In
Penrith, and we always used to talk about those mountain folk. I mean, I love the Blue Mountains too. So
I actually think if you want a resi hotspot, Blue Mountains I think are going to do really well. And then most of the people that do the white collar jobs, or even the blue collar, the fabricators and stuff like that, go to Penrith and they go to Parramatta for their work. Like Western Sydney, the population is 2 million. Like it's a city.
Yeah, it is. Yeah. So we'll pump through these. So that's interesting. Is 6% net yield for commercial considered on the lower side? I think that depends on what it is, I suppose.
No, that's a good yield for Brisbane, Perth. It's a fantastic yield for Sydney, Melbourne. It depends. Regionally, yes. Regionally, you can get 7%. Depends what you're buying, but 6% on average in a good capital city is a really good yield.
Yep. We're pumped through these. How do we factor in difference between capital growth, resi versus commercial? I can rabbit on for hours on this one, but generally the type of commercial will affect the growth. An office space won't grow the same as a warehouse because it doesn't have a land component. Same as an apartment doesn't grow the same as a house. We saw from Jordan last week, 2 weeks ago, where they don't grow the same. But the warehouse has a land component. They'll actually have pretty similar capital growth, and they sort of have to. There has to remain a comparison with price. Like you won't have $1 million house in Sydney next to a 500 grand warehouse, where the $1 million house then goes to $2 million, and the warehouse stays at 500K because all the people in the $2 million houses will go, why are we just buying this warehouse? It rents for 3 times as much, and then that'll flow. And that's why part of the misconception is they have different growth cycles. So it kind of comes a bit later. But if you've got the bare bones of land component scarcity, you will still have really good capital growth. Last 30 years, they're quadrupled in value as well. Yeah. People ask really good questions about sort of even when you should do commercial. And I sort of think we've spoken about it a little bit, but yeah, I think, so would you reiterate that it's generally towards the latter stages of a property journey once you've already established resi?
For a typical standard property plan, yes, because you want to maximize leveraging with the 90% and 80% loans while you can. And then as you've kind of built that net base, then you can leverage into high yielding assets. Doesn't necessarily mean commercial. It can mean build your granny flats. It can be little blocks of apartments, do duplexes, do regional towns, boarding houses. There's so many options there. Commercial's at the kind of top of the tree for cash flow, but it's what you're trying to achieve over what time frame. If I've got 60-year-old clients looking for retirement that don't own any residential, they've sold them all, but they're cashed up. I'm not buying a residential. I'm going straight into commercial. My younger clients, 100%. Let's go residential, maximize leveraging, take on the risk while they've still got the bank of mum and dad to go live with if they need, and then plan from there. So it just depends where you're at.
Okay. So probably have time for 2 more. We'll make this. So how do you determine appropriate rent? I'm interested. I think I know the answer to this one, but yeah, how do you do that, Palise?
Same as residential, comparable rentals. You got to think a little bit harder to get the information with commercial because There's no database like there is with residential that shows all things. Easiest way to do it, if you've got CoreLogic, go on CoreLogic and find comparable sales and then, comparable sales, and then look at how long their leasing campaigns and what they were for. That doesn't mean it got rented at that price. It just means it was advertised at that price. Quickest one, if you've got some good contacts, talk to property managers on the ground. They'll give you the square meter rates and you can kind of calculate it. There's a few methods to do it, but that's probably the quickest.
Yep. Well answered. That was like a speed round. It's like a 10
It was
questions
good.
in 8 minutes. So yeah, I think we'll sort of. I'm interested to know, gents, what are you up to on the next sort of? I suppose I don't know whether I want to ask. I haven't thought about this question, but what do you what do you sort of think? Where do you think you will both be at with your own investing in the next 6 or 12 months? Or I suppose if you want to answer a different question, let me know where you think you'll be at in 6 or 12 months.
No, like I'm going through the process at the moment, just figuring out what sort of ammunition I've got ready to go. I want to be in before August, September, ideally. I'm worried about there being a market bottom and missing it. Like I'm not one of those green shoot investors where I sort of think like, I'll wait till I see everything's positive and then go in. I'd be much rather wanting to buy in a less competitive space. And often it's too late by the time that you get in after you've seen green shoots. You might lose half of that percentage growth upswing. So I'm certainly looking at a number of properties between now and probably September.
Exciting. How good is that? And how about you, Palise? You, I suppose it depends on what if you can take time from traveling the world.
No, I'm moving back. Boom, back in August this year, full time. So I'll be back. Last little stint. As you know, Jeff, I've got a little one due in May, my first. So it's all gonna be happening there. That's
2 months.
sort of it's coming real quick. So
Enjoy.
this is our last overseas trip. So last little one, we've got a couple little weekend drives away and that, but then it's go time. I'm actually looking to buy a principal place of residence on the Northern Beaches at the moment. And I've got, without sounding arrogant, like I've got a good portfolio and I've got a good budget. Those houses that were 4.5, 5 mil a year ago that were out of my realm are now coming down in that kind of 3 to 4 mil. So we're having a look at there. I know full well that that's an emotional decision and it's a happiness decision. It's not the best financial decision. I go and spend $3 million on a house. If I went and bought a commercial, I could have $100,000 passive income. Now I'm going to have a mortgage paying 120 grand a year mortgage repayments. But for me, I will feel wealthier if I can buy that property, pay it off in 10 years, have my base for the rest of my life. And it gives me that security that life can never be that bad. Worst case is I'm waiting tables, paying my council rates on the Northern Beaches in my paid off house. So that's a personal, happy decision, not an investment decision.
Are you going to take up surfing like Jordan? Or you already surf?
I already surf.
Oh, okay. Yeah. How about you, Mike? Do you surf? And we'll finish off on this because.
Geez, what a thing to finish off. I mean, I grew up in country New South Wales. No, I don't surf, Jeff. I did used to stand up on a boogie board towed behind a postie bike on a wheat paddock. So, I mean, I don't want, like Steve's talking about being modest. I don't want to brag. That's obviously very, very cool. But I got the coast a little bit too late. You put me on a mal and I'll stand up, say, 30% of the time.
I think
put him on a mal or a cow and he can stand up 90% of the time.
Nice. By the time I'm 35, I'm going to learn. I'm going to be able to surf. Maybe I should make that 36. But yeah. Anyway, gents, this has been a great session. Really enjoyed unpacking all this, and you can tell by the questions that people are asking. It's really exciting to see that people are starting to sort of get a little bit more sophisticated around the way they're thinking on their investing. So. Congrats to the audience as well. Thanks everybody for tuning in. So if we, I'll throw to Mike first, because given you've been a special guest and spent 2 hours of your time with Palise and myself. So yeah, hopefully we've left you in a better spot, Mike. And if not, then I don't know. I'm sorry. But where can we check you out? If somebody wants a depreciation report and other things, where should they go to check you out?
Yeah, I'm at mcgqs.com.au. I just saw a comment before we didn't get to. I'll jump on that. I'm easy to find on Facebook and LinkedIn, and I'll be speaking at the Accounting Business Expo next week in Melbourne for anyone that is going to be at that, which is probably nobody listening today.
No, I'm sure there'll be lots of people there.
Really?
Doing that.
Well, make yourself known.
And Palise, where can we spot you as well? Like I think people probably know, but where's the best landing place?
Yeah, so Budapest for the next 3 or 4 days. If you want to look me up there, just head over there and I'll be kicking about there. So policeproperty.com, Facebook Messenger, just whatever. You'll I'm pretty active in the group, as you know.
Yeah, if somebody is in Budapest or close nearby, see if you can grab a beer with Steve. Grab a beer with Steve and take a photo and post in the group. Or see. Don't think it's going to happen, but yeah.
Sounds good.
So thanks guys for coming on. Thanks everybody for and in honor of Joe, let's go and look at buying a commercial property. So
yeah,
thanks everybody. Catch you
guys.
next time.